If you have your first $1,000 saved and you're staring at it thinking, should I invest this now? Or should I wait until I know more? Let me stop you right there. Because that hesitation is the exact moment that separates people who build wealth from people who stay stuck. And if you're here, you're already ahead. Not because you're an expert, but because most people never even get to this point. They keep saying one day until one day turns into never. So before we go any further, if you want simple, honest money advice without hype, subscribe for beginner-friendly investing videos you can actually follow, and comment, "Start," if this is your first investment decision ever, because by the end of this video, you'll have a clear step-by-step plan for what to do with your first $1,000 this year without gambling, without confusing jargon, and without pretending there's a magic shortcut. Now let's set expectations the right way, because your first $1,000 is not supposed to make you rich overnight. It's supposed to make you competent. It's training money. It teaches you how investing feels in real life, how markets move, how your emotions react, and how patience actually creates results. And if you treat your first investment like a lottery ticket, you'll get frustrated. But if you treat it like a skill you're building, you'll win long term. Here's the biggest beginner mistake that no one says loudly enough. The biggest mistake isn't picking the wrong investment. The biggest mistake is never starting, because while you wait for perfect timing, inflation quietly makes your cash worth less, and time, the one thing you can never buy back, keeps moving. So the goal today is not perfection. The goal is a simple plan you can stick to. Step 1 is building a foundation before you invest a single dollar, because most beginners don't lose money because the market drops. They lose money because life happens, and they're forced to sell at the worst time. So ask yourself this honestly. If an unexpected expense hit next month, would I be forced to pull this money out? And if the answer is even maybe, you need a small safety buffer first. And no, this doesn't mean you need $10,000 saved before investing. It means you need enough to keep yourself from panic selling. Even $300 to $500 set aside separately can be the difference between staying invested and quitting. The second foundation check is high-interest debt. Because if you have credit card debt charging you 18% or 25%, paying that down is like earning a guaranteed return. Investing while ignoring expensive debt is like trying to fill a bucket with holes. You can do it, but you'll feel like nothing is working. So the simple rule is this: handle the highest interest debt first, then invest consistently. The third foundation check is your time horizon, because investing is for money you can leave alone for years, not weeks. And the beginner question is simple: can I leave this $1,000 untouched for at least 3 to 5 years? And if you can, investing makes sense. If you can't, you're not bad at investing. You're just using the wrong tool for the wrong job, because the market can be volatile in the short term. And short-term volatility feels terrifying if you need the money soon. Once your foundation is in place, step 2 is to give your $1,000 a structure. Because beginners get stressed when all their money is in one place, one stock, one idea, one sure thing, and that stress leads to emotional decisions. So instead of treating $1,000 like one bet, treat it like a team where each part has a job. Here's a simple split that keeps beginners calm. Put about 70% into long-term growth, about 20% into stability, and about 10% into learning. Let me explain what that looks like in real life. The long-term growth portion is the boring engine of your portfolio. This could be a broad stock market index fund or a total market fund that holds hundreds or even thousands of companies. Its job is to grow steadily over time as the overall economy grows, without needing you to constantly make decisions. The stability portion acts as your emotional shock absorber, and this might include bond index funds or conservative balanced funds, which tend to move less when the stock market drops. The goal here isn't fast growth, it's reducing panic so you're less tempted to sell when markets fall. The learning portion is where you learn by doing without risking everything. This could be a small investment in a single well-known company stock or a sector-based index fund, purely to understand how markets move and how you personally react to gains and losses. Investing isn't just math, it's psychology. Now, step 3 is what to actually invest in as a beginner, and the goal here is simple. Don't try to beat the market, own it, because most beginners think success comes from picking the perfect stock. But that mindset creates stress, constant switching, and costly mistakes. So instead, start with broad, diversified investments, the kind that spread your risk across many companies instead of one. In plain language, that means considering diversified index funds or broad market funds. These funds are designed to track large groups of companies instead of relying on a single stock. For example, total market index funds give you exposure to thousands of companies across the entire market, while S&P 500 index funds focus on the largest and most established U.S. companies. Some investors also include international stock index funds to diversify globally, or bond index funds to add stability and reduce volatility. For beginners who prefer simplicity, target date index funds offer a set-it-and-forget-it approach by automatically adjusting risk over time. The core idea is diversification, spreading your money across many companies and asset types instead of relying on one winner. Over the long term, this approach benefits from economic growth despite recessions, wars, elections, and scary headlines, which is why the biggest advantage you can give yourself is time in the market, not timing the market. Now, this is also where you need a simple avoid list, because the fastest way to blow up your confidence is to copy what looks exciting online. So avoid chasing trending tips, avoid day trading as a beginner, avoid jumping in and out based on news, and avoid buying something you cannot explain in one sentence, because if you don't understand what you own, you will not be able to hold it when it drops. Here's a quick mindset shift that protects beginners. Knowing what you'll do when the market drops is more important than knowing what you'll buy today, because markets will drop at some point. That is normal. And when it happens, the question is not what if, it's when. So decide now that a drop is not a signal to panic, it's part of the process. Step 4 is how to start today without overthinking. And this part is where most people get stuck, because they want the perfect account, the perfect platform, the perfect timing, and the perfect list of investments. But perfection is just fear wearing a smart outfit. So the simplest action plan looks like this. Choose a reputable investing platform in your country. Open an account. Pick one diversified long-term option for your growth bucket. Choose a stable option for your stability bucket, and put a small amount into your learning bucket. And then set a habit that continues after the first $1,000. Because the first $1,000 matters, but the habit matters more. And this is where dollar-cost averaging becomes your best friend, which simply means investing a fixed amount regularly, regardless of headlines, because it removes emotion. It turns investing into a routine instead of a debate. And it helps you buy more when prices are down and less when prices are up, without trying to predict anything. If you have access to tax-advantaged retirement accounts where you live, this is often the first place to consider for long-term investing, because the system is designed to reward long-term behavior. But regardless of the account type, the principle is the same. Keep costs low, stay diversified, and stay consistent.